All right, folks, welcome back. This is our weekend commentary for the ICT Mentorship. And again, thank you for your patience on Wednesday. So, I didn't get any trading in except for a demo trade on TradingView from my app on my phone. I'm getting prepared for our wedding anniversary coming on the 14th of February. So, I was a smart guy in the beginning. I knew if I was going to get married, I was going to marry her on Valentine's Day. So that way I can never forget it. Not that I ever would. All right, so we're looking at the dollar. I'll go through this real quickly and then get to the lesson tonight. Daily chart on dollar. Okay, so we're going into the weekend. A few days ago, Putin gave a pretty pointed speech about NATO and basically their part in whether or not the Ukraine's going to be invaded or not. And there's a lot of tension there. And Europe and the European countries basically were put on alert and attention that, hey, look, I got nuclear bombs. And if you look at the way Putin spoke in that, and I know some of you don't even want to hear all this stuff, but it matters, okay? I mentioned that I'm bearish on dollar unless war. Now we're going into the weekend. Typically that's when things kick off. And I don't know. I just got the impression that Putin was basically like saying, okay, I'm done. You either understand where we're at with this or we're just going to go. And that would be a perfect distraction to all this COVID stuff, all the poor leadership that's in the U.S., a distraction from the poor leadership in Canada. Everywhere, the UK, everybody's got Muppets, in their leadership roles. So sometimes they just want to watch it burn. And there it is. So there's a little bit of uncertainty, I think, going into this weekend. I've been bearish on equities as well, and you know that. But if the dollar starts to go higher because we see a steep decline, like say we have a huge gap opening lower this week coming up in equities. Okay, say the futures gap down a considerable amount. It could happen. That would cause real concern, and that would cause a jump into dollar because of its flight to safety, flight to quality, and I'm saying that with my tongue in cheek. To be honest with you, I'm not really that interested in Forex at the moment because I think the next event is going to be in the stock market. And I'm going to say the word, okay? It doesn't mean it's going to absolutely happen, but it feels like we are in the right conditions. We could see a flash crash in equities where it just can really, really drop a lot. And just be careful if you're out there playing around with stock indices, because you see me doing it now. Just be careful, because if you don't know what you're doing, man, it could get real fast and ugly. And your stop loss doesn't work when it just runs right through it with a gap, and it can gap during market hours. Don't think that the gap can only occur at the beginning of the week. It can be right in the middle of the day. Right there, something happens, boom. We're down 300-400 points in one tick. Don't think it can happen? Don't be on the losing side to discover that's not true. It's definitely something to be concerned about. All right, so dollar index, I'm still favoring weakness, but if we get north, okay, if we get north of this imbalance right here, okay, I don't see it returning back to this as a bearish order block and selling off. If we get to the upper end of this imbalance and we trade through it, on a closing basis, now this is important, on a closing basis, then I'm going to put my bearish stance on dollar to the side and assume that we're probably going to go for that blue shaded area on the weekly chart. And then if it goes there, it's probably going to go higher. And especially if there is some kind of a war event that kicks out, like if Putin goes into Ukraine and starts sending in, weapons, or launches weapons into Ukraine, then it's on. It's going to kick off. So just be watching for it, okay? And just nothing you can do about it. There's no reason to be panicking about it, but obviously there's some concern, and that is going to reverberate into these markets. Whether you like to hear these things or not, it's not political, okay? It's technical, okay? These things are going to have a lasting impression on the minds and the relative risk to reward view that traders are going to have. And the markets will use that to either instill fear or greed. One of the two. Either one is manipulation, and I don't care which one it is. It provides momentum, movement, displacement, energy, velocity, all those things that make up trading as a very fun endeavor that can be easily profitable in very short time. All those things are helped with, like I mentioned when I was teaching in the commodity section. I don't want to see people go through droughts and lose their crops or a war break out. But those things in the hands of someone that's initiated like you are, you can take those instances and make them a profitable endeavor. Not that we want to see those things happen to people, but we can't personally stop it, right? So I don't feel that there is a moral dilemma there. If there's an opportunity, I'm going to try to take it. I'm not out there burning crops down. And I certainly don't have nuclear bombs at my disposal. So it's a matter of me simply saying, okay, well, this is what's going to happen in the world. I know human psychology is going to be what it is, and it's going to be fear and greed in the marketplace. And that creates a lot of momentum and movement. And that's what we like and need as traders. So we'll be playing it by ear, seeing what we get. But again, my focus really isn't on Forex. It's on the stock indices. Forex will start moving around again. But right now, the movement is really expected and being seen in the stock indices. Euro dollar. All right, so again, because Europe was basically threatened and we're going into the weekend, just a complete risk off scenario. Drops back down into an imbalance here. So this is all a bullish order block. So I'm not looking at this as runs up and goes down because it's too weird looking, isn't it? It's like a big rectangle. I think if it's going to go lower, it would make sense to come up here a little bit deeper, right? Or if it goes up here and finds some support, runs up into this area here. Again, either way isn't high probability. So with equities, I feel very confident that they're going lower. Okay, so I guess if you were gun to my head, ICT, wouldn't that mean that dollar goes higher, equities go lower, and it's risk off, so euro should go down and all the foreign currencies should go down as well? Yeah, but I don't trust this environment for it to be just that black and white. So again, this is why I led this year into basically saying, don't do anything, don't engage, don't engage. You're welcomed to engage in your demo account to trade the US 500, US 100, and the US 30 if you're outside the States with the demo. If you're in the States, you're welcome to demo trade TradingView if you're willing to pay that $4 charge. And honestly, it's nothing. I mean, that amount of money is nothing to get insight, to be short-term trading, day trading, scalping. You can see real quick what I've been able to do with one contract. Now, granted, that's the mini, but just look at it as 1/10 of what I've shown. You can do that with a micro. So it adds up, folks. Going into cable, this one here, it's back to who knows what it's going to do. It's back, and it's in the middle of the range between this low and this high. So yes, there are movements occurring in Forex, but the real volatility is in the NASDAQ and the E-mini S&P and the Dow futures. So that's where my focus is. That's why I'm pushing you all in that direction as well. I know some of you are just stubbornly saying, I'm never going to trade those, but you're cheating yourself out of experience, because the same level of expectation that you have in those markets is transferable to these markets when they're moving more liquid, when there's a little bit more interest and excitement. Right now, nobody's trying to do anything with other currencies. Why? Because the markets are being held hostage because of the global supply chain. Things are held up. Basically, global trade is being strangled right now. And because of the supply chain being held up and held hostage, that's why we're seeing a lack of interest in these currencies, because there's really no need for them to be moving around, because there is no liquid trade between all these nations. There's a lot of, I'm keeping mine. Well, I'm keeping mine. I'm not going to sell to you. I'm only going to sell to that one. So it creates a disinterest in making these currencies move around. So why does it have an impact on these currencies? You have to buy and sell, right? So if there are large buyers and sellers out there not interested in buying and selling a currency because they don't have the capabilities to do trade right now, they can't go out and just buy up a whole lot of stuff to go sell it to people, because a lot of people don't have any money. They've been out of work for 2 years or whatever. They've been impacted. So think about it from that fundamental stance. I get emails from some of you in the mentorship, and you're getting frustrated, like I'm somehow holding these markets up. Like, what's going on, ICT? Why can't we? Like, I'm not pushing buttons and making these charts paint. Okay, so don't kill the messenger here. I'm taking your attention to a market, an asset class that is moving. Whether you choose to trade it or not, this is what you should be doing anyway, studying that one. There's always going to be a chasing of yield. That's why all the excitement is in these equity markets. Plus, there's a lot of real risk in that market too, because there's a lot of 401ks, which I think are jokes, because I think they're going to get raided. I think they're going to eventually get to the point, because they ran up all of the deficit in the United States, that they're just going to do a bail-in, and they're going to take people's money like they did in Greece. And what could you do? Nothing. And they limit you to $75 or 75 euros a day coming out of your ATM. But no matter how much money you got in there, it doesn't make a difference. So I think that day's coming, especially if they rig the election again and the Democrats stay in power. We are up. We're up the creek without a paddle, put it that way. And I think the United States average citizen is going to say BS, and we're going to be doing something different, like what's going on up in Canada. We have all those truck drivers that are out there. I think something's going to kick off this weekend with that, folks. Trudeau is, I know this sounds like a rant. It's not. I'm just telling you what my view is, why I'm not interested in currencies right now. I want to be where the excitement's going to be. And right now, the risk and the fear of losing is in the equities market. The U.S. equities market, that's where it's at. And it's downside opportunity. So, no global chain supplies are open right now. They're stagnant. And that's creating these really lethargic price moves in Forex. I can't make it any plainer than that. Yes, there are some currencies moving around. Yes. But I'm not trading the crosses. I'm not trading a euro yen, or a pound yen. I'm not doing it. So I have to stick to things that are more appropriate for me for tax purposes, because I'm a U.S. trader. I don't get the same tax benefits. And you may think of it, well, it's not that big of a deal. You should be doing it. No, don't tell me what I should be doing. I'm telling you what you should be doing. You didn't come here to be my instructor. You came here for me to instruct you. So I'm giving you my experience, but some of you don't want to listen. You take it as a means of wanting to argue. And my best advice is for you to just take the advice I'm giving you and see how it pans out. And I think you'll appreciate what I'm doing with you. I'm protecting you. I'm guiding, I'm navigating and helping you guide your attention to the market asset classes that are moving. I don't know how else to say it. I mean, it's simple, but some of you are just really stubborn and you think I'm trying to keep you from making profits or move. I'm not doing those things, folks. I'm trying to get your attention where it should be. Okay. So anyway, pound dollar, I wouldn't touch this thing. I have yet to find anything interesting in this pair, and I don't have any interest in it. None. It's not a matter of me taking this and saying, okay, let me take it out and put another currency in, because there's not another currency I'm interested in replacing it with because of the things I just stated. Now, war changes all that. War changes all those things and makes these markets come alive. You'll see them moving around again because they'll be doing things that are required to exchange between ally countries. And that is what's going to cause these markets to move around. Okay, so that's enough of that. Let's go over to the teaching for tonight. I promise I'll try to get through this as smoothly and quickly as I possibly can, but still covering it comprehensively. All right, so this is the daily chart of the NASDAQ 100 E-mini futures contract. I'm using the continuous chart. So if you go to TradingView, type in NQ, and then look for NASDAQ E-mini futures contract. Click on the main header. When you do that, it's the first one that says continuous contract. Okay, click on that one, and you'll get this. This is not the March delivery contract. It's this one because I wanted to keep these notes here and not muddy up my normal March contract because I have annotations I use for my own purposes. All right, so we're looking at the daily chart, and I'm going to counsel you to go out to your weekly chart again and look at this shaded area here, because that from this high and this low, that imbalance, that's what we traded up into on the weekly chart. And I mentioned that we were going lower, and we have a low resistance liquidity run signature here. We have sell side resting below that. So we did trade up into it. We overshot the volume imbalance, but we didn't get much further than the premium high of the weekly imbalance. Okay, so it went up there. The bodies stayed inside, came down outside of it, and then one more time pumped it up into all these wicks. And then going backwards after this run up, what we're doing is noting all the daily lows. I'm not interested in the daily lows in between, like this one here. I'm not interested in that because we have this one and this one, and we're already opening down below it. So it only is of an interest if it trades up to it, what you see here. But on the sell side, or sell side liquidity, that is interesting only to me when it's below the lows like this. So I'm looking at it like swing lows. You see that? Except for this one here, which is after it leaves the up close candle. So that's why I have that one. So we have sell side below that low, that low, that low. And then I'm obviously drawing your attention, as I mentioned the other day. This is where I think it's ultimately going to trade, and maybe even lower than that. It can have a flash crash and literally do a move like this in one day. That's what I think could potentially happen here. There's a lot of fear in the marketplace, a lot of people looking at what has happened with Facebook, and it got eviscerated. And in a couple weeks, there's a platform expected to come out. And for the life of me, I just can't remember what they're naming it. Something BWAC or DWAC, or don't quote me on it, and I don't have time really to go looking for it. It's supposedly Donald Trump's social media platform. So about 2.5, 3 weeks or so, it's supposed to come out. All of the social media stocks will probably get ripped to shreds because of that. And I'm thinking we'll probably see some kind of cyber event because of that. So if not before, because they don't want that type of platform where things can be spoken freely, and it's going to be all kinds of cyber stuff. That's what I anticipate. If it doesn't happen before, it'll be really soon after its launch. Just putting it on record. Okay, so am I going to join it? No. I will not be joining that. Absolutely not, because I just think it's going to be attacked, and I don't want any kind of malware or any kind of viruses in my systems because I'm using that application. I don't use a TikTok. I don't use Facebook. I don't use Instagram. I don't use Discord. I have a Telegram app that's in a phone that does not have service. I just use it like an iPod. Remember the old iPods with no phone service to it? I don't have any connection to any of my financial records, any of my email accounts, nothing. I just simply use it for Telegram because I don't trust Telegram. So anyway, I believe that the equities markets have real risk. And I'm listed all kinds of things just now. I think all these things are future to come. And I think a cyber event is absolutely looming in the offing. And obviously that could happen. The worst case scenario is for them to find out that they somehow hacked the New York Stock Exchange. And that may sound absolutely impossible. Like that could absolutely, no way on earth can happen. Well, let me tell you something. If there ever was a time where that needed to be done and distract everybody from all of the lunacy that's been going on for the last 2 years, brothers and sisters, let me just preach to you here for a second. Right now, that would be enough. That would be like the September 11th of 2001 on steroids. Like it would be, oh my goodness, it would be absolutely, it would rip the trust of anybody holding their money in these markets. Like that would be Armageddon financially. Like it would be unbelievably relentless. They'd have to shut the market down for a few days, if not a couple weeks. That right there is going to have pent up, fear and worry. Obviously, I'm not trying to say anything like this to scare you, but I'm just thinking out loud because these are the things I have wrote in my own journal. These are things I'm actually expecting, to be honest with you, as potential curveballs because we're approaching the midterms in the United States in this fall. And what do they have to campaign on for the Democrats? Nothing. They have nothing. They've done nothing but cause trouble. They have messed up everything. So they have nothing really to campaign on, which is why I think they rammed that several $1 trillion in there to put it back in their pockets, because they're probably never going to get elected again, ever, if we have a fair election, which I'm not convinced that we're going to have one. So there's so many factors that are not conducive for low risk appreciation for stocks going higher. I just don't see it. It's not in the cards at all. Just look at the lay of the land right now. I mean, there's not that many stocks holding up these averages. Majority of the stocks are actually lower. They're going down. But because of the market cap of the ones that have been going up, it kind of pushes these averages in territory where they're really not justified. So in a layman's way of saying it, so that way it's short and sweet and I'm not boring you any more than I already have, it's easier for these indices to collapse and go lower dramatically than it is for them to rally to new highs where they are. That's kind of like what I'm getting at. So because I think that's a possibility, I really want to be paying attention, because if these markets do crash, I want to be in history and say I rode some of that. Okay? I want to be a part of this. So, and I'm willing to lose some money to be a part of it. I don't care. Like, this is something that could be historic in terms of unbelievably relentless. And I want to, like I said, I want to be a part of it. But anyway, we have the sell side liquidity pools here. And what I'm going to be teaching you now is high frequency trading. Now, there's ways that I'm not going to be able to teach you. And there's this method here, which I believe is sound. It's good. And I've hinted at periodically throughout the mentorship. I said that kind of this time of the mentorship when we're closing up the core content and majority of the lessons, but that doesn't mean the mentorship's over. It just means these are my intended lessons. These are the things I wanted to teach. And then once I got them out of the way, then I get into that question and answer phase where we're in the forum, and when you ask me a question, I'll answer you. Okay, I'll answer your post. It'll be a back and forth dialogue. Everybody will see it because I've delivered, in my opinion, everything that you would need. But it doesn't mean you're all going to understand it as you should. So any questions or any concerns you have, we can hash that out as a community in the forum. I don't need to make videos and all that stuff. It'll be just a direct Like you would be emailing me and I would respond to you. Well, instead of doing that privately, which I don't want to do those things. I got students still sending me emails. I have no time to get in there. I have too many students doing it. So I'm reserving all that stuff until we get to the server's no longer delivering videos and we're in the forum exchanging. Okay, like baby pips. There's no videos there unless I was putting them there, obviously, but everybody communicated through the forum posts. So that way, when you ask me as a student, this is what I need to understand better. Okay, when you post that and I respond, your user group will see it. And if it's a noteworthy inquiry that hasn't really been brought up, I'll copy it and I'll add it to a thread in the other user group. So nothing's going to be missing. Okay. You'd be surprised how many reoccurring questions or very similar questions that students have from all the user groups, but predominantly the 2021 group that came in because they rushed. I made it available for them to go through the content faster than they should have. I knew this was going to happen, but it helped us with the administration side of it. But just know that you're not going to understand everything about what I'm going to show you here just because you watch this video. It's going to require you several times watching it. Don't worry, I don't get ad revenue from it. But it'll grow in your understanding because of the additional insights that I'll be sharing. And you'll see me doing trades and you'll see me doing mock-ups, demo account trades and positions. All those things will help solidify this. A lot of you aren't going to want to trade like this, but there are some of you that have a real interest in learning this, and that's fine. But don't look at me running these demo accounts up or that live account that I'm doing with TD Ameritrade. Don't look at that as enticement. Well, I want to do it because he's doing that. I don't want you thinking that way. Okay. If you're not interested in this type of trading, don't worry about it. Just watch it for the sake of experience. And then once we're done with this lesson, never worry about it again. Okay. But if you learn this, it'll help you get into trades that you missed the best case entry on. Like say you were looking at an entry that you want to go short in London Open and you missed it. And say it's already dropped down 40 to 50 figures. That's never fun, but it doesn't mean you can't participate. You can use a entry technique like I want to show you here, and it'll get you in. Okay, and you can finesse, not chasing it in the sense that like a retail trader would say, "Oh, look at that! It's rocketing up and sitting right at the if the candle closed right now, it's at the high." And I'm looking at it. Wow, I'm going to buy this. That's chasing. We don't do that. So with those parameters and foundation laid, let's go into this. Just know that these lines here, that's the sell-side liquidity pool. I'm bearish. Okay. Before this day starts, I'm bearish. I told you I was bearish. I'm looking for these lows to be taken out. Okay. The setups from a intermediate term to short term is going to be best formed inside that shaded area because it's the weekly what? Imbalance. And it pumped up in there one more time. We had a down close yesterday. It was a nice sell-off day, and continuation is likely going into Friday because no one wants a holdover weekend risk. All right, so when I'm looking at starting a campaign of high-frequency trading, I kind of like want to consider all my time frames. The benefit of having multiple monitors is this style of trading. Okay, and you don't really need a lot of monitors. Like I have a lot of hardware and a lot of screens in front of me, which you don't need. Okay, I get questioned all the time. Can you please show us your trading setup? I want to teach you everything, and we're almost done. What I have as far as an agenda doesn't mean that we're done teaching. Okay, it just means these are the topics I wanted to cover, and then you come to me as a student in the community openly. And then this is what you need to learn more about. Okay, and then I can address it. But if I show you what I have, but I will, once we complete everything, I'll show you my trade setup. I'll show you all my hardware, how it's laid out, how many monitors I have, which ones I use, this, that for. You'll see all that, okay? But I don't want any of you thinking that you need all this. You don't need to have NASA, okay? You don't need that. You could trade Forex off your phone. I don't recommend it, but you can. I don't want to trade on these fast markets like this on my phone because I miss a lot of the moves because I like to be able to see more of the charts. So like you saw yesterday when I was plinking, I didn't take any live trades in my account. That account has not moved. It didn't go up. It didn't go down. Okay. And I wish I would have took a screenshot or logged into it. I'm not going to do it. Okay. But just to prove it to you before we get into Monday, I'll pop up something on the forum. You can see that nothing's happened. I can't trade on the weekend. Equities aren't open. But I think we're past all that. Prove to me ICT, this, that, and other stuff. At least I hope that's where we're at now as a mentor to a student. But nonetheless, this style of trading is going to really need to have multiple monitors. Now you can create multiple chart layouts in TradingView. If you have a big enough monitor, you can create all these little, what would be otherwise monitors. Like for me, like I have a lot of 27-inch monitors, and you don't need 27 inches, but 27 inches really gives you a really good vantage point, and you can see very easily what the market's reaching for. Because if you're just looking at, the last few days on a 4-hour chart, you really can't appreciate what it's trying to do. Whereas if you're watching it on several time frames and several charts, where it only requires you to glance over this one and then glance to the other monitor that has another time frame. Like one chart had this is what one of my charts would have. Okay. Now I don't have these annotations. These are just for you to understand what I'm looking at. My charts are naked. Okay. That's it. Sometimes I'll put an annotation reminding myself that, hey, 10 o'clock, consumer sentiment is coming out. Okay. So that way I'm mindful of that. I just want something like that to remind me of the economic drivers that's going to come in. There's volatility injections because of the economic calendar. Those things, if I get distracted because my family or my wife or my dogs come in, like I did a video on YouTube, and that's real world stuff, and that can happen to me. I'm not a cyborg. I'm a real guy. So those things can creep in. Someone can come to the house and knock on the door and say, hey, here's a package. I got to get a signature or whatever. Those things will distract me. And if I come back to my charts and say I'm looking at something because I was looking in an email, I'm trying to answer a student's inquiry about something, that could cause me to forget about what's expected to come in the day. So I only have like a text annotation about something like that. Otherwise, my chart is absolutely naked. There's nothing on it. I don't have any line segments. I don't have none of that stuff. But I can't teach you with a naked chart. I have to have annotations. So what I'm looking at here for the daily chart, this is what I have in mind internally when I'm looking at the daily chart. This is one monitor, okay, one individual screen in my setup. I'm looking at it continuously because I'm submitting myself to this candle expanding down when I'm bearish or expanding higher when I'm bullish. And I'm constantly referring to where it's at in relative terms to like these things I'm showing you here, these sell-side liquidity pools. On another monitor, I have a 4-hour chart. Now, I don't talk a lot about 4-hour, and I've done that because of brevity's sake when I'm doing the commentaries. When I was doing, all the markups on the Forex pairs, I omitted the 4-hour because I didn't need it. You didn't really need it. But if you're going to be doing high frequency trading, I want to be aware of what other sell-side liquidity pools may be ran into that I'm not technically seeing on that daily chart, but still giving me a higher short-term intraday view. So in other words, it's not a daily higher time frame, but 4-hour to me is like higher time frame, but just a little bit higher time frame. So I have a lot of faith in this one. But the setups that I'm looking for aren't generally going to form on this time frame that much. But if they do form on this time frame, I know I have a good chance of catching a tiger by the tail. It means I got a runner potentially forming because this time frame is close to the daily, but it's not as fast as the hourly. So an hourly is like a day trade. 4-hour, that's a short term to overnight hold, for a position like that, not holding for weeks or anything like that, but 4-hour can be utilized for short-term trading too, like, 1 to 3 days. So on the 4-hour, see that we have a small little gap in here. And this was the daily sell-side liquidity pool here and here. See how it looks different versus the daily? Let me go back one more time. Totally changes the way you see that when you start dropping down into the lower time frames. It's not as obvious because you see all these other little ones. And if you're new to trading, you'll start asking yourself, well, why isn't he worrying about this one? Or why isn't he worrying about this one here? Because I'm using the higher time frame top down. So daily to 4 hour. So I'm going to have more concern placed on these specific lows because it's anchored on the basis of it's a daily chart perspective. And then we have the order block here. Last 3 down closed candles right before up here. Changing the state of deliveries right there. And then all these lows, but anchored to that low here. That's where sell side is. Okay, so I'm thinking it's going to go below here, but if it's going to go below here, it's probably really going to have no problem getting down there either. So I have that in mind when I'm looking at the chart. Again, I do not have these little things drawn out on my chart. My eyes going to them, I'm receiving the information because I'm used to doing it. I see it, I make a note of it, and there it is. Mentally, I'm making a note of it. I'm not doing anything on my chart. This is only for you to understand what ICT is thinking about when he's looking at this particular chart with this much data. Okay, this is all I have on the chart. I don't have more data than this to the left. Why? Because the point of drawing down into this sell side liquidity pool is the whole basis of where I think this is going. I think it might go lower than that, but right now, the context is I think it's going down to 13,715, we'll call it. Okay. I don't even know what that low is, but it's going to go down there. Okay, that's what I'm thinking. I could be wrong, but my analysis says I have to submit to this in terms of if I'm going to be high frequency trading with the bias, which is the highest probability, I can high frequency trade against the bias, but that takes a lot of skill and none of you are prepared to learn that. I'm not suggesting that I will never touch on it, but I'm saying right now, I don't want you to think that way because you're going to think you can do it and you're going to hurt yourself. And you're not going to learn anything from it yet because if you can't do this style, counter trend trading, high frequency, you're just going to just beat up your account and blow it probably. So with these levels in mind, I'm watching the daily on one monitor, the 4 hour on another monitor, and then I have another chart on another monitor. So on one section of my desk, I have 4 monitors to the left and 4 monitors to the right. Okay. On the left-hand side, upper left-hand corner, and you'll see I will show you this, but for the sake of understanding how I have it laid out for each monitor, upper left-hand corner is the daily, upper right-hand corner is the 4 hour, lower left-hand corner is the hourly, and in the lower right-hand corner is the 15-minute time frame. So I'm watching those time frames on the left-hand side of the same market I'm looking at. On all, like in other words, they're all basically the same market. On the right-hand side of my desk, I'll have 4 more monitors, and I'll have one that is basically watching a correlated perspective, like for SMT purposes. I'm watching bonds in another chart. And then the other 2 are a 5-minute chart and a executable time frame. It may be a 1-minute chart or it may be sub 1 minute, like 15-second, 5-second, 30-second intervals, something like that. And that's really what I'm watching. I have more monitors than that, but that's like my working real estate. That's how I'm visually going through. And I'm just literally standing at the desk and I'm looking, glancing, making sure I'm getting a read on everything. I'm cycling constantly through the daily, the 4 hour, the hourly, the 15. And I'm going through that. Once I go through that, I go back over to my 5-minute chart and my 1-minute chart. And I'm looking at the levels relative to what I have marked out in my mind, not on my chart, on the group of charts on the left-hand side of my desk. Because those are where the liquidity pools are of my interest. That's where the bias is derived. That's where the expansion of the daily range is going to be moving towards. And I'm submitting myself to what that set of 4 monitors in that real estate on my desk is providing the information of. So I'm paying more attention to that because the entries are not that big of a deal. As you're going to see, there's lots of entries, but you need to know the best entries. You don't just go in and say, well, I feel like I'm going to do some high frequency trading and I'm just going to go in here and just chase everything. No, there's elements that I'm going to teach you here that make it better. So that way you're not just going in there indiscriminately, just grabbing something and saying, okay, I'm bearish, I'm going to sell it right here. and see what happens. It's probably going to be the opposite of what you'd like to see happen. But this is the lower left-hand corner chart on the left-hand side of my desk. Okay. So I have, again, that gap that's on the 4 hour. I'm looking at that same level here at the 14,730 level, thereabouts. I'm considering that as well. Now, you're not going to see this like I'm able to see because I've been doing it for a long time. Don't try to think like, oh, ICT doesn't put anything on his chart, so I'm not going to dress mine up either. You need to do it until you know what you're doing. So, yes, in the beginning, I did these things, but I want to keep a clean chart because I want to be flexible because I can trade both directions. None of you can do that efficiently yet. So don't try to be like me before you're ready. There's a lot of things you got to learn, and none of you are ready for that. Okay, so just grow and bloom where you're planted. I'm giving you something that's extremely difficult to do. Let me make sure you understand that, because it's going to look real easy with me outlining this. But don't be fooled because it's hindsight and I'm showing it to you and it's going to feel like you can go out there tomorrow or Monday and start killing it. Don't do that. You want to study, go back through your old data and see if these things aren't repeating. So anyway, the same liquidity pools I'm watching on this time frame, and you would do the same thing if you have a way to put several charts on your same screen, which would really compress. But you can create, several, like, I don't know, six little squares on your chart or your trading view. I think you might have to have a subscription level that allows for that. I don't know. I don't get any money for it. I'm just going to say, don't do this. That way you know I'm not getting a kickback. Okay. I had somebody email saying, are you getting paid through TradingView? Because all of a sudden now I'm not recommending anything except for the fact that you guys ask me. And I'm telling you what I avail myself in terms of resources. They're not free. Just because I'm IC doesn't mean I get it for free. I have to pay for the same kind of stuff that you'd have to pay for. So none of this is a kickback to me. I pay for the same resources I use. Nobody gives me a free lunch in anything. Okay, so this time frame, I'm watching all those liquidity pools. I'm watching to see how the ranges expand. Am I getting any pullback into order blocks like this one here? Okay, we opened here and we traded up. When this was running up like this, I'm not looking at that thinking it's going to overlap and go, because we have a swing high here and we've reacted off that fair value gap on the 4 hour. And I can see how the bodies have respected consequent encroachment of the gap that was on the 4 hour. I know the levels. I know what I'm looking for number wise. That's how I'm seeing it. A lot of you are in that stage of your analysis where you have to see visually. It has to be visually represented on the chart. Otherwise, you can't see it. And that's what I'm trying to tell you. These are like training wheels. Before you started riding a bike with just 2 wheels, you needed training wheels. You needed dad or mom to hold your seat so that way you don't fall. That's what these are. Don't look at these as, oh, I'm not elite like ICT because he doesn't use them. I used them in the beginning, but I like to have it clean now because, again, it allows me to be flexible. I know by reading a naked chart when it's likely to reverse for a short period of time, and if I feel inclined to take a trade that's counter trend to that, I will. But I don't want to have all these things on my chart that might scare me out of a trade that might be really good for counter trend retracement. So, again, all these things are not going to be applicable to all of you. Only for the folks that want to go really, really deep into intraday trading and day trading and scalping, that's what this lesson's for. Okay? But I want you all to study it because you'll see that the same signatures I'm teaching you on other time frames are occurring in this model. All right, so anyway, the last 2 up close candles, I'm viewing that as a potential bearish order block. Why? Because we ran up here. So I got a swing high in here, and buy side's been taken out into an imbalance here, and then we had a reaction as we would expect to see. The candle opens, trades up into the bearish order block here, expands down through this. So now we have a change in the state of delivery there. Now this order block becomes active, which it goes right to it here. And I'm watching each one of these candles forming. Every new hour candle opens, it opens, and it starts to go up here, I'm not looking at that as, oh, it's creating a swing low, I'm going to go higher than this high. I'm not looking at that. I'm looking at, does it reach up into that order block, and does it respond as I would expect it to? That means it hits it and then starts to come off and sell off. That's what I want to see. I'm constantly getting feedback visually by going through my daily, my 4-hour, my hourly, 15-minute. And as each candle starts to expand down, I'm referring to each one of these pools of liquidity, because that's where the market's going to draw down into, because there's real orders down there for sellers that want to sell at the market. If the market prints and marks to market at that level below the old lows on the daily chart, that's where these lines are coming from, remember? As each time it trades below that, my mind is saying, okay, smart money is taking partials off here. They're taking a little bit of their short off. And then it expands. So if we go below that first, well, this is technically the second sell side liquidity pool here, it goes through it. The next candle opens, trades up into, what's this? Consequent encroachment of this tail. Standing out in time, bam. I'm watching that. As it's forming, I'm watching it. I'm telling myself, when this candle was full on bullish at that point, because it opened here, it trades up into that, I'm watching, is it sensitive to that level? And if it hits it, starts to sell off, I know that we're going to go to the next pool of liquidity, which would be below that low here, which is technically a daily low. I didn't change these lines. The only thing I did was move it so it says the abbreviation SS for sell side liquidity. I'm not a Nazi. Okay. So the opening trades up into consequent encroachment and sells off. And once it trades through this sell side liquidity pool, look what we've done. Sell side liquidity pool taken. Sell side liquidity pool taken. Second and third now expands. Now I'm thinking we're in the latter stages of the afternoon. We're in a stage where there's going to be a rush to get out. They're going to squeeze on anybody that went long thinking there was a low formed in the marketplace. And they're going to mad dash gun for the remaining sell side liquidity pools, which is this one here. Look how fast it dives into that. Then it reaches down into the order block. So how many things got reached for and hit? Several. The whole time I'm watching this chart, I'm referring back to the time. What time of day are we in? What time of day is it that it should expand and finish out the daily range? Are we in the PM session? Are we getting close to that 2:30, 3 o'clock hour? And algorithms are going to really start pumping in and pushing price around, not buyers and sellers. Okay, the algorithm is going to start delivering price to these levels. It's going to spook, scare buyers. What are they going to do? They're going to sell. Every time this is going down further and further, it's engineering fear in the marketplace. So longs are doing what? They're puking their guts up, for lack of a better word. So they're selling their long positions. And that's flooding the market with what? Counterparties for them to liquidate partials of their short position. So they're funding their position as this whole thing's dropping down. Sellers are coming in because of their lack of interest in holding long. So they're selling, and it's creating sell market orders continuously. So that provides perfect counterparty to them covering partial on their short position because they have to buy it back. Well, they have to have sellers coming into the marketplace. Then it hits the order block. End of the day, done. Closes on the low. Left-hand side of my desk, lower right-hand corner chart. Here we have the 15-minute time frame. And I'm watching this for the framework of my high-frequency trades. So you can see we have that same order block on the hourly chart here, where it trades up into it there. We see that gap up here. I'm looking at the price levels. I'm not, again, these levels here, they're just helping you see it. But I'm looking at where we are, because it's something entirely different when you see the charts right next to each other. Daily, 4-hour, hourly, 15-minute time frame. You might look at this and say, I don't know how he could have ever seen or keep track of these lines not being on the chart, but see the levels. Because you can see the price just cycling from, you know, your eye moving from daily to 4-hour to hourly to 15-minute time. It's easy. It's real easy because you can see where you are relative to the daily, the 4-hour, and 1 hour. And those levels that you would be looking for liquidity pools or imbalances or order blocks, you can see that price on that chart. So you know that price is, we'll just call it 14,592. Okay. So you can see it clearly on the 4-hour, or you can see it clearly on the hourly chart. So you're watching it relative to the movement on the 15-minute time frame without a level drawn on it. You don't need it, because these charts are going to be printing identically whatever the most mark-to-market closing price is on the candle you're looking at right now relative to any of those time frames. It's all going to be the same price. And what I'm saying is on the right-hand side, this price axis, they're all showing that same last price right now. Whatever it's marked at right now for market price, it is easy, and I'm probably making it more confusing than it needs to be, but if you have 4 charts, if you have put four different charts of the same thing on your trading view, okay, and set up the daily in the upper left-hand corner, right-hand corner 4-hour, lower left-hand corner is your hourly, and your 15-minute time frame on the lower right-hand side, and watch price without having any annotations on it, and you'll see how easy it is to keep track of everything. Okay, but in the beginning, it's useful for you to have these annotations because you're new, and it's not a bad thing. It's not, oh, you're still an infant, you're just never going to be good enough, you're not elite. You got to train yourself. Once you train yourself, you don't need to have training wheels the rest of your life, but you may decide to keep them on there, and there's no shame in it either. Okay, but the market trades up into the bearish order block, and once it does that, in my mind, I'm thinking, okay, we've bounced off of this old low, but we really didn't sweep it. So it came back up to a bearish order block. So now we're in a short-term premium after breaking out of this area down here. So I'm anticipating another run lower. So I already know I have a scalp set up from this level here to run out below this low. But we're also in an area where this market could expand on a very large range for the daily chart. That daily candle could be really large today. So I don't want to sell short and lose any of that range. So here's what I'm thinking in my mind. I'm thinking that this is hypothetical because I did not trade today. I did not take any positions whatsoever, but this is the same rationale that I go through and process and protocols and things I'm looking at. I want to try to put something on not just one lot. I want to put multiples, okay? And it may require, less margin than I would otherwise like to use. Like, say this is a Forex pair, okay? I might reserve, if I have 4.5% I want to allocate to risk on this particular market, then I'll take the 4.5 and split it. In the first entry, I'll take 2.25% and allocate it to that. So what's my maximum amount of leverage I can use? Whatever my equity base is, times it by 2.25%, and then use this range here where I'm trying to enter, where my stop would be, and then I can take something off, but then hopefully later on in the run I could add more to it and start pyramiding it. But I'm also funding, because it's going to be the first partial that's coming off, because first in, first out in the US. So I want to try to put a larger portion on up here, because that allows me to peel off the majority of the move when I take a partial off. And in the later area where I take an additional pyramiding, I want them to be smaller pieces. So that's not a big deal, and I'm not in a hurry to take those off. But I want to have the bank of majority of my orders on the short at the first part going in, because I want to be able to pull them off as it's going down. Because again, FIFO, first in, first out. Whatever first order you put into the trade, that's the first one that has to be taken off or liquidated. You can't take off, later orders. So anyway, once I have all these 4 charts constantly referred to and I'm watching and monitoring, I'm looking for, does the market want to go lower? It breaks lower here. The next candle opens here. I want to see, does it trade up into these up to close candles? Bearish order block and immediate rebalance potentially there. Okay, so it trades up to the order block, goes back into this range. And once it does that, does it want to go lower? I submit to time. It comes off that high, and the next candle opens, starts to rally here. What's it doing? Going into consequent encroachment of this wick. So I'm constantly getting feedback from institutional order flow. midpoint, extending out in time. I'm watching, is it sensitive there? Can it touch that order block level again? Sure. There's nothing wrong with that. But I'm watching this wick because it exists. It's in the chart. I'm thinking it's going to go right there at a half point, and then it does and sells off. Now, I'm watching this on my cell phone because I'm watching it and I'm putting in demo trades. I'm literally putting in a demo trade and I'm monitoring it, and I want to see, does this market give me an opportunity? Okay, I'm watching price. My entries are up here. Okay, but the partial you saw the exit on. But in my phone, I'm watching. In my head, I'm telling my son, look at this. It's going to go up here. It's going to go down here. All these things that I'm teaching you, I'm looking at real time as I'm watching each one of these candles paint. Once it goes to this consequent encroachment of that wick, I want to see it expand. And does it take out this candle's low? It does. So now we have up close candles being broken. Order flow is bearish. It's reacting off of all the premium arrays as it would normally. And then the next candle here, look how close we are to that liquidity pool, that level. So we open here, small little movement up, and then smashes all the way down through two sell-side liquidity pools. You see that? When we go into a really lower time frame, you'll see what this is, and you'll probably start grinning. But we work underneath this sell-side liquidity pool here, sloppy manner down into the order block. Now on the right side of my desk, upper left-hand corner, I have the 5-minute chart. And this is what I'm seeing. This is where my setups are. So the fair value gap is here. The market trades up into that. That's where you see my entries. Okay, I did 2 of them. I did one as it's going into the imbalance, and then one at the top end of the range. So it was a little bit of heat on the trade, but again, when you're taking this trade, you're going to have to use the stop up here and just trust it. You can't use a lot of leverage, and you just go for it. The market trades down, retraces back up in, gives another opportunity right here, sells off, small little rally again, and it breaks. There was 10 o'clock in the morning, a medium impact. I think it was consumer sentiment or preliminary something. I can't recall exactly what it is. Don't quote me on it. But I know we had a medium impact news driver for the U.S. at 10 o'clock this morning. And that's what caused a lot of this hiccup in here. Okay, and then the imbalance was created here. And we had the obvious, retracements, optimal trade entries back to the fair value gap, and then breaks lower. Big beefiest up close candle at your bearish order block, and it had 1, 2, 3, 4, 5, 6, 7 candles where you could have got in on that. And I think, if I'm not mistaken, this one here too. Yeah, it looks like it. Yeah. Double check that one just for your own record. It looks like it hit it there too. And then sold off. Now, this is the framework for the trades. Like you have one right here with the fair value gap. Then you have the order block right here, and then the retrade back to it. So what is this? Reclaim the bearish order block. Bounces in between, then breaks. What's this? Imbalance. Comes right back up into the bearish order block. Does it hit that? Yes, the body's respecting it as well, and then expand lower. So inside of this framework here, once it gets down to here, I'm not interested in chasing anything more because we're in what you'll see in a moment. All right, so the 5-minute chart cleaned up a little bit. Here's that imbalance around the 9:30 opening. Lunch hour, no trading, but the imbalance inside of lunch, I'm looking at that because it's a very fast day. If you don't want to refer to this, that's fine because you can go back over here and use these up close candles here that stop right before the lunch hour begins. So remember what I was teaching about distortion and the time effect with time distortion? Take the candles out of the lunch and you have this trading back up to, say this was missing, like we didn't have these candles. What are you referring to? We're going to go back up into this area here, these order blocks, or this order block. So draw that out in time. Hits it, should sell off, and it sells off. PM trend early. It starts real fast on the other side of lunch. Technically, it actually began in lunch. But it retraces back up. Look at the body's respecting that. That is such an amazing phenomenon, isn't it? I never, ever grow tired of that. That to me, just every time I see it, it makes me smile because that's proof. That's proof that there's an algorithm. You're telling me that every trader on the planet is trading and stopping their buying right there and initiating only selling right there. That would mean that the 90% lose, data point, that's a lie, right? No, because this is a net sum zero game. 90% of retail traders lose. Who's on the other side of their trade? Us. That's why we're in a 90% bracket. Because we're looking at things they can't see. They have no interpretation. They have no books telling them. I mean, obviously they have me out there pushing it now, but and all the clones that I've created, they're parroting me. But they're only saying my words, and they're looking at charts on the left-hand side. You're learning and seeing me trading it. Like, it's really happening with a live account now. You've seen me do it with demo. But these things repeat over and over again. And the only way you're going to grow in your understanding is by you going into your charts and annotating them, logging them, and researching and studying them. And just get used to looking for these signatures, because when they repeat over and over and over again, your brain will recognize it when it starts forming live. And that's how you jump ahead in your learning curve. There's no lessons I can give to make it easier in that regard. You still have to do these things like going into charts. And that's why a lot of people quit. They just don't want it. They don't want to work for it. But on a fast day like this, usually around 2 o'clock, 1:30 to 2 o'clock in the afternoon, that's when the next setup forms. But look how fast, right outside of lunch at 1 o'clock, immediately it goes right in to fill that imbalance there. And then, boom, that's where the move starts taking place. Doesn't waste any time, because it has to fulfill its weekly range, its daily range, and it's trying to get down to those liquidity pools, the ones I showed you on that daily chart. This is really close to what it would look like, but obviously I have these annotations that denote time of day, lunch hour, that type of thing, and these levels up here. But I'm not looking at that. I'm aware of what those levels are price-wise, and I'm watching the last price as it goes to the next one. I'm watching as it goes up and down. I'm watching the tape. I'm watching up and down. I'm not looking at that price, obviously, but I'm referring to the candle's formation, and I'm watching over here, glancing over to where it's at relative to the actual mark-to-market time and price. So what's this price showing right now? That's what I'm referring to in reference to what those levels are on the daily chart and 4-hour chart and 1-hour chart. So it's a lot of things to manage, and that's why I can't have people standing next to me talking. I'm not interested in being in front of a group of people, over my shoulder looking, because invariably they're going to ask me, why did you do that? And why aren't you worried about this? And why aren't you looking at this? And why didn't you consider this? Forget that. There's no way. Like, I can't concentrate with that. So I have to have either my headphones on and I'm playing some kind of music, or I'm jamming really loud with with my music playing, and hopefully nobody's coming in, to interrupt me, so that way I can focus. But if I had all the annotations on the chart and I wanted to have all that stuff, it would probably be easier for me to have, slight distractions. It would certainly piss me off and, make me more likely to lose on a trade or misinterpret something because I'm being distracted. But I prefer to have it naked, not having anything on there. But for you looking at it, these are the time and framework of this particular day and why it's forming this way. A lot of volatility because you have that 10 o'clock consumer. I can't recall exactly what the driver was, but some event came out at medium impact at 10 o'clock, and it caused a lot of the whipsaw in here. But there's the imbalance. We broke below the swing low here, broke down below it, rallied up, filled in, and then reclaimed the fair value gap right there. Right there, it sells off. Bearish order block. So there's your setup in the morning. There's your morning setup. Lunchtime hour, we don't do anything. Immediately on the very first candle coming out of the lunch. Boom, it fills in the imbalance. Here's your chance. Get in here. If you ain't in here, it's going. Boom, it starts taking off. So you have to be very quick. On days you anticipate a lot of movement, that small little consolidation, and don't think that there's going to be a small consolidation all the time for the lunch hour. Sometimes there'll be a move that just completely just rolls right on through and maybe even accelerates in the lunch hour. There was times in the open outcry period of trading where the pit traders that would be literally out there on the floor calling out, with their hands, signaling, hey, buy this, sell that. And I apologize if you hear my dogs upstairs. I have hardwood floors and they're up there playing around. I'm going to be giving my sons some lip service tonight because that just broke my concentration. But the immediate speed after the lunch hour, anticipate that when there's going to be a likely big range, close of the week. There's lots of liquidity pools that haven't been taken in consideration or tagged or ran into, like I showed you on the daily chart. There was lots of liquidity. There's lots of candy under the market, even right here. And that's where they dove it into that. Just drove it right down in to get all those sellers. Because below the lows is what? Sell side liquidity. Smart money that's selling short up here, like us, they want to have sellers at a lower price. At the time of their entry, they already know below old lows is what we're aiming for. That's what they're digging into it here. And on the 1 minute chart, once the market hits that bearish order block, let me go back up. Okay. It's trading up into an old order block, and let me see. I'm not going to be able to see on that one. Here. This is that order block that was on the 15-minute time frame. Okay, so 1300 is 1 o'clock in the afternoon. This little run right there, that right there, that's what's hitting on the 1 minute chart. Right there. So we have a little bit of an imbalance there. It retrades back up into the order block and trades lower. That's a setup right there by itself. Done. If you don't hammer that and go short, when you have this retracement up, that's an optimal trade entry. Expect it to trade off because I'm watching that 15-minute, hourly, 4-hour, daily. I'm expecting this turn here to roll down to attack this pool of liquidity, this pool of liquidity, this pool of liquidity. That's what I'm looking at on the higher time frames. As the market accelerates and goes lower, look what happens right here. This is like a trade I would take also that I'm not putting a lot of leverage in, but I'm in there trying to take a surgical strike. Because I have the expected pools of liquidity in my mind and what I have annotated on the charts. If I see they haven't really purged any of it yet, and we have a breakdown and the next candle trades up into this little fair value gap, I love seeing that because remember what I've been teaching. In down moves, okay, down swings, there isn't a lot of up-close candles. So the up-close candles set up new selling opportunities. Vice versa. When there's a price swing going higher, there's rarely down-close candles. But the down-close candles set up new buying opportunities. Either you buy while it's dropping, or you buy after it rallies above it and treats it as an order block. That's institutional order flow. So don't be afraid to engage and study price action. Like if I'm bearish and I see this here, and when it rallies back up into this imbalance, if I see this candle forming up and we haven't really gone down into the liquidity pools yet, that right there is a scalp for me. I'll go right in there and hammer that and go short. And then once it runs down below the low, I'll take it off. Let's look at just from filling in here, and we'll call that 14,400 just to be safe because I don't know exactly what that price level is. But 14,400. If it just goes down to a run below this low, then this low here, once it goes below that, we don't even need to get all this move. But let's say we just get below that low right there. That is essentially, we'll call it 14,355. Okay. What would that be? It's 45? 45 handles. That little move is 45 handles. That's 45 times $20. It's not a lot of money, but 45 handles is nice. Another one here. We trade down. we create a swing high, we break lower, relative equal lows, low resistance liquidity run signatures here, and it rallies up, and then it breaks down again. What do we have here? It's taking out a swing low in a day that's what? Bearish. So we took out buy side here. We took out sell side here. Rallies back up to what? The imbalance. It's already done the taking of the buy side. So don't be fearful of taking this high out if you go short here. This low here just took out sellers to get them caught on the breakout. This run here, that's the next optimal trade entry. Runs down lower. Below this low, or below this low and this low, once it trades through it, it doesn't need to get down to that order block. That's what this red level is here. Remember the order block level? So each one of these is a potential scalp. Running up into it here, running up into it here. It's an order block. Or I'm sorry, optimal trade entry rather. Optimal trade entry, sells off. Then we have another small little imbalance there. It's not much, but look at the time frame. It's 1 minute. So it runs up again here, and we could be aiming for that order block as your exit. But when it trades up into it and sells off, you want to take something off below that low. And as it's screaming down in here, one of two things can happen. One, you can say, okay, it's going there. It might get there, but I'm going to have to take my stop and put it down into a level where it makes sense because we're getting close to that low. And sometimes we can have a wicked retracement. It's kind of like this one here. It's not a lot, but it's, well, I guess it is in this sense. It's 100 handles. 100 handle move retracing there. That's $2,000 if you had a mini. If you had a micro, it's $200. All this run here. So then it breaks again. Imbalance. Look through the wick. We're not Sam-sided. Cut through that here. Trades up into it. Sells out liquidity here. And right below it is what? The order block. Sell it here. Sell it in here. Imbalance. One more time at the what? Discount low. Optimal trade entry. What's it going to gun for? This low and the order block. And boom, hits it. Those are the types of trades I was doing on Thursday just to get the account up to 40,000. Because the other trades I did, again, using my cell phone because I didn't have internet hookup, our Verizon for television and for internet was gone. We didn't have any of it. So to help me pass the time, I was just taking little scalps through my phone, which again is not a recommendation. Don't do that. But if I would have had better visibility in my charts in front of me, I could have easily done $4,000 yesterday, and I could have done $10,000 today if I wanted to push it. But again, I don't want this account to be, oh, look, he's blowing it up. It's crazy. Look how fast it's growing. Because that's not the first impression I want to give, because I've never shown you all live account trading. I want to be meticulous about it. I'm going to show realistic gains, not something that's ridiculous. But think about also the bond trade. Like I could have pulled $10,000 out of the full run today in NASDAQ. If I just got in there and held it for the day. That's $10,000 there. I had 5 short on bonds, March contract on Thursday. And I just said, no, I better take them off because I don't want that to be in the account either, because it's not something I believe you all can do. Because if you're transitioning from demo and you've made a decision on your own that you're going to trade with live funds, not that I'm telling you to do that, but if you ever get to the point where you elect to do that, I don't want you looking at this campaign I'm doing with the live account and trying to think, wow, ICT made $10,000 short in bonds in one day, and then he did $4,000 in NASDAQ the same day. So that's $14,000 I could have done on Thursday. And I could have easily done $10,000 today. That would have put that live account at $64,000 just today. In fact, I could have really worked this daily range and took multiple positions, getting in and out, scaling it, and doing more than $10,000 and still just be one contract. But I'm not trying to do that with the first one. So I think what I'm going to do is I'm going to use 2023 to be like my year to just spread my wings. In other words, I just want to show you what I can do. And I won't have all these distractions. We'll be really comfortable together in the forum. And hopefully I won't have so much demand put on my time with everyone asking, a million questions. I hope I'll get through the rest of this year and kind of like satisfy the majority, if not 99% of everyone's residual questions. And then we can just enjoy each other's company and share each other's ideas about what's going to happen, hint, hint, nudge, nudge, in the marketplace. And here's the 5-minute chart. Here's also the high frequency trading setup that you can do. When I'm looking at price action, and I told you, I said these are where my setups would form. If I'm not taking the setup here for the entry, or say I missed it, which I didn't miss today. Obviously, you can see it in the demo account for TradingView. I did execute there, right here. But let's say I missed it, and the market's doing this. It hits the discount low, the fair value gap. It breaks down, and it does this little monkey business in here. Can I use this area here to get in a trade? Yes. So I'm highlighting this little area, this little price action window right there. Forget everything to the left of it. And obviously, we got to pretend that none of this formed on the right side of it, okay? But what is in place at the time of this box of price action, okay? When this candle starts forming, what's available in price right now? We have this old low on a day I'm bearish and you're bearish. And we have this old low over here on a day that we're bearish. So in this shaded area, let's go down into an ultra time frame that's very, very small. This is a 5-second chart, okay? And I wish I wouldn't have had the annotations on it. I wish I would have had a naked chart. I wanted to ask you, what do you see? Kind of makes it obvious now when I have the lipstick on it. But consolidation, we rally. All the down closed candles, once it starts expanding away from the original consolidation, down closed candle, this could become a what? Bullish order block. It trades away from it, and then it comes straight back down into, boom, order block. What should happen when it does this? Price should rally. It should react nicely and go higher. Does it do it? Yep. It even gaps. See that? I like that. I really, really like that. If it starts gapping on these lower time frames, that means it's in a hurry. This right here, that little gap right there, volume imbalance, that's the very thing that the algorithm goes right back over these old price runs to fill in. Oh. Remember that paint analogy where I said when you put the roller in the paint and you apply it to the wall, the very first few seconds, or say the first rolls of the paint roller going on the wall, the paint distribution is going to be lush. It's ample. Okay, there's no little pockets where it didn't get distributed on the wall. But the longer you start rolling that roller up or down, eventually it's going to start having these little pockets or gaps where paint did not get distributed evenly on the wall. This whole background of the shaded pink area, that's the wall. The roller is the algorithm. The paint is price. So when we had this down closed candle and it starts to roll up here, look how nice these candles are. Rolls up, nice, 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 nice. And then look what happens. It starts getting what? It's out of paint. So what does it have to do? It has to go right back down to the area where it picked up paint before in down closed candle. Draw that out in time. It hits it there. Now it has more paint. But now watch what happens. It's in a hurry, real quick. So if you take a paint roller, even if it has a lot of paint on it, and I know this because when I was 16 years old, I used to work for a painter. And it was student painters. It was a company. We went around and we did jobs and such. I hated it because the first 6 months I had to scrape, and that sucked. I didn't do any painting. I was doing all the grunt work. But they taught us when we put the paint on, don't be in a rush because it'll create porous pockets on the wall. Well, that's exactly what happens here. We drop down, even distribution of paint to the wall, and then we start running out. So now what does the algorithm have to do? Go back down in, pick up more paint, and then because it's got to get somewhere, it's in a hurry, it starts going real quick. And you have these little porous pockets. Right here, see, here's another one. Volume imbalance there, and a volume imbalance there. See that? Now again, this is 5 seconds. That is so fast. Like, you need to know exactly what you're looking for, and your finger needs to be on the button, ready to go. and I'm ready to go. I like watching these time frames because my brain is like I can pick up on changes in the delivery, and I can also change my mind. And because I'm bipolar, I can go from euphoria to aggressive, you don't want to be around me. Like, I can swing just like that. And that's why I've used that gift, where everyone else would call it a disability. It's a gift. I've used it as a weapon against traders that don't know how to trade well. And I bridged that internal dialogue with price. So when the algorithm's creating these little areas in here, I know it's likely to go back down to that level. Okay, I know it's going to be wanting to go back into this level here. So, but we have our first order block outside of the range. The consolidation in here that starts the what? Market maker sell model. That's what this is here. When we leave the consolidation, the last down closed candle, that's your initial order block. We want to see if it wants to dip down into that. So that's your first stage of what? Accumulation. Then we start tearing off higher. This one here doesn't necessarily need to be revisited yet. But this one here, we're farther away from here. So it might need to come back down into it. And it does. Look at that. Volume imbalance gets filled in. Down closed candles. What is that? Potential order block. Look at the opening, not the wick. Look at the opening. That's where the majority of the volume is. It trades above it. The change in the state of delivery is that what? Opening price. It trades above that and then does what? Digs back down into the order block. Picks up more paint. Then off to the races again. Look, gaps with a volume imbalance. Is it likely to come back and fill that? No, because it's right in the area of it's starting to run. Don't look for that to be filled. It's going to act as what? A breakaway gap. Runs away. Reaches an objective. We don't need to know what that objective is. Okay? We don't need that. This day we're bearish. We're waiting for the market to turn. Okay? It breaks down. Swing low. Broken. Displacement. Even on a 5-second chart, folks. Then it comes back up and breaks once more. Okay? So now we have this here and we have this here. Wait. We want to see it come back down into an area of old what? Accumulation. To do what? Pair it up with distribution. So right away, when this is starting to go up and it starts to turn here, where does your attention go? Right below that low. That's where sell side resides, right? So below this low is sell side liquidity. When we have this break lower and the next candle closes, it only takes 5 seconds for that to occur. You've got to really be on this. This is like the highest form of, like, you're literally, like, connected to the computer. Nobody's allowed to come in your room. All the lights are out. You're zoned in. Like, this time frame is the ultimate, like, you don't want to miss anything, okay? You don't need to do the 5-second chart. It can be done with a minute chart, obviously the same way. But I'm just showing you the depths of what you can do with what I'm teaching you here. How the algorithm works. Okay, what is it doing? What's the repeating characteristics? And remember now, folks, remember, you're going to be challenged by other people that are stupid, as dumb as rocks. Okay, they're going to say, ICT and his made up narratives and his made up this and that, and these two guys didn't really teach him anything, and this over here didn't really occur, and there really is no algorithm, and this, that, and that thing. Look at this 5-second chart. And think about all that nonsense. And then look at what I'm showing you here. Because watch. There's your first, well, what would be the first reaccumulation point over here as it's coming down. Inside that range of these down closed candles, extend that out in time. There's your imbalance. Look what it's doing, folks. You're going to tell me, you're going to sit here and argue with me that is what? That's random? That's supply and demand? No. Nope. No. What supply and what demand exists on a 5-second chart? It's not there. What this is showing is AI. It's referring to the very things I'm teaching you. And folks, I know there's some of you in here still, and You want to still subscribe to this Wyckoff guy? I'm telling you, none of that is real. It's not. It's not. It's not. It's a perfect way of explaining history. I'm telling you how to interpret, decipher, and crack these markets, because this stuff repeats exactly how I teach it. Not because of somebody else's jump the creek, break the ice, all that stuff. Forget all that. That's a perfect way of explaining yesterday's weather. I'm showing you how to catch the next wave on a sunny beach in paradise and ride it. Okay, looking at this thing, that's your first level of reaccumulation when it's coming down from the curve. Sell side, boom, gets right into what? Match up the accumulation with a distribution point. This is what? First stage distribution. Here's your first accumulation. Leaving the accumulation of this consolidation, this order block, this down closed candle, where the algorithm is telling smart money to buy. They're looking for this. If they miss it, they missed it. Okay? But this is repeating on all time frames. This is showing you how price is fractal. So if you take this area and you shade it in and you expand it out in time, what's in here? Fair value gap. It trades back up into it. Yes, there's a little bit of errant price action where it just goes above that candle here. But how much movement is that? It's minuscule. It's so small, it's not even worth mentioning. But it fills in that gap in an area where what? It should start to sell off. So over here, smart money would look at that and say, okay, I already know if it goes below that and comes back up in, I'm going to be looking for it to be a selling opportunity, especially if I get my little cheater code with a fair value gap right there. Trades up into that. Bam! Hit it. What is this? Second stage. Say it with me, folks. Second stage redistribution. That's the unicorn. And here it is on a 5-second chart of NASDAQ. Oh, yes. Yes, indeedy. This is high-frequency trading. Look at the movement on that. Let's just say it's 14,630. Okay? The run is to get down below here. Each one of these candles is 5 seconds in duration. So say you entered on this candle here. 5 seconds, 10 seconds, 15 seconds, 20 seconds, 25 seconds, 30 seconds, 35 seconds. Basically 30 seconds, you're literally taking 30 handles or more out of the marketplace in 30 seconds. Hello? You don't see opportunity there? Yeah, it's there, man. So when I see these opportunities on these lower time frames, okay, and I'm watching my chart and it's in sync with everything I've walked you through tonight. When they set up and everything's in alignment, they're the ones I go after. And I pinpoint where I'm trying to get in at, and I'm waiting for these types of setups. And when it forms, that'll teach you for listening to it with headphones. ICT, you so-and-so. That was too loud. It is a beautiful thing, folks, because this, I've never sat down with any of my students, even when I was doing it one-on-one. I have never shown them this. Now, obviously, there's people in here that share my videos. There's people that are going to obviously take it and try to teach it in a book, teach it in a course, teach it on their YouTube channel, whatever. Okay, they're going to try to do something. They cannot do it. They will not be able to do it live because it takes a long time to get good at this. You'll be able to see it and talk about it after it happens. But unfortunately, the world's full of frauds, fakes, wannabes, and just low character individuals. But there's rules that you have to follow. And you have to know what you're looking at from top down. You have to know where the market's going to draw to. Watch what happens here. Remember, these are 5-second candles. So when it trades down here, you can put a position on here. Say you put on, I don't know, say you put 5 micros on, okay, or 5 minis. Say you have a pretty sizable account and you put 5 contracts on here. Once it goes below this low down here, you can peel off, say 3 of the 5 you have, and then have your stop at even, and then ride this out. Why are you waiting throughout all this? Well, first of all, it's not that much time. It's only 5 seconds each candle. Remember the dashed line. Let's go back up so that way you remember what this is. That's this low back here, okay? So while it went below this short-term low here, the real draw on liquidity is what? Below that level for the setup. So once you get below it here, you would take your remaining 2 off or whatever, okay? So your position entries here, you have a sell stop, liquidity pool here. You want to take more than half of it off because these little time frames can have a lot of whipsaw price action. It could revisit this level. Why would you want to give up 30 handles if you couldn't take something off down there and it returns on you? That's not fun. It's better to completely collapse the trade. Here's something for your notes, folks. If you're trading and you have first level of partials expected and you don't take that off and it comes back up to your entry, that's usually a bad sign. Not always, but usually it is. You would do better to completely collapse the trade and eat the likelihood of it moving in your favor and going the right direction versus sitting in that and watching it become a losing trade and take your stop. That sucks. That sucks. It feels so much better to say, you know what? This is probably going to turn on me. I know I can find other trades. This is not the hill I'm going to die on. This is not the end of my career if this is the wrong decision. And I don't want to take a loss. So the first rule of longevity and consistently profitable trading is what? Preservation of capital. Protect what you got. Because if you don't, no one else will. I can't do it for you. Your broker certainly isn't going to try to do that for you. So when you're taking levels off here as partials, you want to take more than half of it off. That way, if it does come back on you, you've paid yourself handsomely. But this retracement here and all this, you're submitting to time. I'm watching a time frame that's not the 5-second. I'm watching the 5-minute, the 15-minute, watching it reach to this level. And once it starts getting close to that, in my mind, as it's getting down here and this candle opens and trades down here, I want to see what? I want to see it dig in there. I want to see it go really aggressive below that. And it, for the most part, it does about 10, 15, almost, 15 handles below that. And then it starts to go the other way. But it gives you ample time to get off your remaining 2 positions or 2 contracts. Like if you had 5 here, took 3 off below here, ride this out, and then boom, you take the final 2 off there. And then look for another entry. Now, it's important to know that if you trade like this and you do a lot of these types of trades, yes, it's fun. Yes, it's profitable if you're correct. But it increases the cost of business. And you could easily run up, like I have done. I think I got 1,150, we'll just call it 1,100 and some change in commissions already for the year. Now, obviously, I think I did 3, and I'll have 1 more day of latency tests for the month of February, and then I'm done, where I'll be doing a lot of trades, and I'll probably burn a lot of commission costs there, but it's not that big of a deal. I don't care. But once I have that, then I'm done. Then it'll just be less trades each trading session, and that's all they'll be. And that's how I want the rest of the year to be. But barring any days where I made an error and I took a loss, if it requires me to get in there and fancy dance and eat up the loss back to a gain, that's the only time I would trade more than 1 or 2 each session, like the morning or PM session. So I guess the best case scenario would be getting in one day, one time for the day and riding the daily range out, or getting in one time in the morning, one time in the afternoon, or take 1 trade in the morning. If it's a loss, try 1 more time in the morning. If I win it or get even, I'll go in the afternoon with less of a risk. It has to be less than the risk I took in the morning. I'm only trading with 1 contract, so it has to be a stop that's half of what I took in the morning. If I can't find it, I'm not going to take a trade. So you have to have all these rules about, when you make money, you want to keep it. You don't want to have a winning morning and give the money back to the marketplace in the afternoon. That sucks. So one of the rules about efficient trading in my mind is managing your day results. If you have a goal of not trying to lose money on the day, it's going to make you feel like every trade matters, because it does. But if you are loosely looking at the marketplace and thinking, well, if I take a loss, whatever, or I can't take a loss, it's only going to go in my favor. Both of those mindsets are incorrect, and they will slap you bad in the marketplace. And when you take a loss with those mindsets, it is debilitating because it makes you afraid to take the next setup. And you don't want that. You can't have analysis paralysis. You cannot do it. So if you are trading like this and you have a losing trade and the next trade you take a losing trade, do not go to live. Don't do that. Drop down your risk as you would if you were going to take a live trade, but in the next trade, do it in demo, because you don't know what that trade result's going to be on the third one. And if it's a win, it helps build you back up, but you didn't make any money yet, and you're not rushing to get that money back. And then once you do another trade in demo, to make sure you work out the kinks in that little fear that would come in, then go back to your live trading, but do it with the reduced risk that I taught you in the mentorship. And then go that way, because it'll help you remove that element of rushing to get your money back, because you don't need to have that money back. You don't need it. It's going to be there. Just look at it as you lending it out to somebody else, and you're going to collect interest for it later on. That's how I look at it. That's the way I internalize a losing trade. It's a cost of doing business. I'm giving out money because I know I'm going to get interest on it. That's the way I look at it, and it's served me well. And it may not work for you, but it works for me. All right, another way of looking at it, here's a 30-second chart. And this is that fair value gap. And if you see here, this price low at 14,624.25, it rallies up. And then we have a breakdown. Okay, it breaks down and has a gap here. So once we trade into that fair value gap, and then we have a displacement here, we can trade up into this fair value gap. These are the levels here. You can see it's about 50 handles if you're getting in at this candle's high to get down to this level here and below it. So entering here on this candle, taking a little bit of heat, that's fine. The stop would have to be above here, or if you're worried, you can do the next candle here. But sticking with the rules, the stop is here. A little bit of heat on this candle. How much time? 1.5 minutes. So 90 seconds of heat before it starts working for you. And then it runs from your entry candle here. 1, 2, that's 1 minute. 2 minutes. It takes you 2 minutes to make 50 handles. Now, obviously, this is a fast day, but I'm looking for days like this. That's what my analysis is teaching you, to find these big days, these big candles. These big candles you can do a lot of work in, and you don't have to have the best entry of the biggest part of the move. You can go in and say, okay, I missed the ideal entry, so now what can I do? You look for these types of setups. So if I miss selling short up here in the fair value gap, and I turn my charts on, or I'm been distracted, I come back and it's starting to move away, and I missed it, immediately I'm dropping down to these sub 1 minute charts, and I'm going to find these opportunities, and I'll use that. That's not chasing price, folks. Getting in sync with order flow. And look at the results. I'm not in there long. Then it's bang. Get it, take it, and run. Another one here. This is in the afternoon. This is in the 2 o'clock hour. Same day. We have another run up. The market has a gap here, fair value gap, after it takes out market structure. So there's a shift in market structure. The market rallies back up. Trades into the fair value gap, low resistance liquidity run signatures. And if we take the high to low with the fib, negative 0.5 standard deviation, that would be a good level to reach for, and it trades into it handsomely. So we'll just call it, what is that, 24? It's 100. Yeah, that's 100 handles. Yep, 100 handles from entry here, below here, down here. Now you could do 2 contracts or like a micro, 2 micros, and once you take your 2 entries here, one comes off below the relative equal lows here, and then look what happens. It retraces, comes right back up in, and say you missed this one, but you see this setup, this framework, you can sell short here and use the same logic of what you would have used if you were entering up here. Or ideal scenario is you sell short, like say, I don't know, say you sold short 8 minis or 8 micro here. And it trades down and it gives you this setup here, but you know the target is, this is the framework down here. You can sell 4 more here. So the big positions here, half of it or less gets added to it as an additional pyramiding. You enter here and you ride it out. This is exactly what I was doing in those demo accounts on Twitter. And this is exactly what I was doing on TradingView. Okay? This is exactly what I was doing. There's no fraud that's required. You just need to know what you're looking for and you engage it when it's there. When you can afford to do more contracts or lots, if it's Forex, you just use the equity you have. And it's it. That's all it is. And I'm leveraging, some of the trades were like 5%, but usually it's 4.5% to 5%. Each trade, each position entry, 5% at maximum here, and then 4 to 5% entry leverage on that there. I'm not saying that that's a good thing for you, but that's exactly what I was doing to make those accounts blow up crazy. And every time I was making money, it would make that demo account have more equity in it. So it would allow me to do bigger positions every time these things formed. I don't know why anybody doesn't just simply just take a look at it. And I'm doing it with TradingView. I'm at 235% return since I think the 3rd of February. No losing trades. And its positions are, like I took $11,000 out of demo money on that demo trade I showed on the community tab on YouTube. But it was me entering in the morning session in the fair value gap, 2 entries inside the fair value gap and at the upper end of the fair value gap because it went just a little bit above it. Boom, done. And I didn't take the whole daily range because if I would have done that, they would have been like, oh, well, can you teach me? I'm teaching you that tonight. That's what you're getting. They're not getting that. You're getting that. Another one here. This is at the 3 o'clock hour. Market breaks down, creates an imbalance here, displacement. The 3 o'clock hour, this is not nice in here, but generally the 3 o'clock hour has a really nice swing, and I'll leave it to you to study it, okay? But 3 o'clock to 4 o'clock, there's generally a nice little setup on these lower time frame 1 minute or sub 1 minute. But you have to have the framework like I've been showing you. So if you have something on a 5 minute or a 1 minute chart that gives you structure to work with, then you drop in these lower time frames and it becomes what would be expected on like a daily or a 1 hour chart. But this is 30 seconds each candle. Small little gap, trades up into it, optimal trade entry, overshoots it, but this is the area where I want to enter. Look at the bodies, consequent encroachment. And now think about where is the liquidity. If we ran from here up to here, midpoint is right in here. So order block, right? So sell short here, aim for midpoint of the range. It creates a swing low there, trades right back up into it again. Now we have the same logic. It's a down day. It's 3 o'clock. It still has room to go down. It didn't trade down to that order block yet. It does it here. So it's doing what? Reclaimed fair value gap. Yes, it overshoots it. We have a volume imbalance there. See it? Then it breaks lower. So sell short again. Now aim for the liquidity below there and the order block. Sell half of the range. That's YouTube. Reclaim the fair value gap. Sell. Aim for the sell side liquidity pool. Bullish order block for the daily range low of the day. Boom. you're going to have to find in this what your personal niche is, what you want to do. But do not try to find 20 trades a day. Don't do that. Try to find at most 4. Like if you have a limit, I don't know how to keep track of it. Other than just simply, I just wouldn't recommend you doing more than 4 trades, even in your demo account, because it's easy to overtrade. And you can still make money, but generally when you trade too many times, number one, your costs go up, and it's more likely that you're going to have a losing trade. And that losing trade can really burn you. Like when in these very small time frames, a fast move that really isn't covering a lot of distance can mess with your head. But even in these ranges here, I mean, think about what you're looking at though. Like you're selling short at 300, 14,300, and trying to get out below here at 200. That's 100 handles. That's $2,000 per contract. Profit or loss if you're wrong. But if you're selling short up here, getting out down here in the order block, that's about 40 handles, 50 handles. Then you have 100 below that low. If you're holding out down here, it's over 110. So it's $1,200 per contract for NASDAQ. So hopefully I've stimulated your interest in studying on these very, very, very short-term time frames. Maybe some of you are like, there ain't no way in hell I'm going to do anything like this. And that's fine too. Like I said, this is me teaching you comprehensively and also in a way where it allows you to pursue your own interests. But you can see that these elements that I'm teaching you, they're in price. And they're in all these time frames, even these sub 1 minute time frames. So most retail traders are not using less than a minute chart. They're not doing that. So to think that all these Wyckoff, supply, demand, Elliott wave, all that stuff, you're trying to tell me, okay? You're trying to tell me that the market knows those methodologies and it's deciding on what time, what day, what market to follow those specific logic? Really? Like that takes a great deal of faith that makes absolutely no sense. That's the definition of religion to me. You're believing something that's so unlikely that it's madness. Now, take a step back and take ICT out of this whole conversation, okay? The man that's talking to you right now, just take me out of the equation. Look at what I'm showing you. Isn't it so easy to just look at this and say, you know what? There is an algorithm, and it's pricing these markets from an artificial intelligence perspective. It's doing it automatically with no respect of buying and selling pressure. And it's doing it on all time frames because you can see it, you can measure it. It's statistically measurable. You can see these things occurring on all time frames. That's how you know it's following macros. These short little lists of commands that it's designed to follow. All this is, folks, is a computer program. If you buy a video game, okay, and I'm going to say this in closing. If you buy a video game and you put the game in your system, you start playing it, can that video game do anything outside of what it's been coded to do? No. It can glitch and not do what it was programmed to do because of hardware issues or software, something happened, okay, and it just doesn't allow the player in the game to do what it was intended to do. Or maybe you'll go off the map, okay, and you'll be doing something that the character's not naturally supposed to do. That's a glitch from a software stance. These markets cannot do anything outside of what they're programmed to do until there's manual intervention. When manual intervention comes in, that's where, like, your wife or your husband comes in and you're playing the game and they push the off button on the system. You don't get to have your moment of, I did what I was looking to accomplish in the game. Or if you have a sibling. Maybe it was like that when you were growing up, because it's happened obviously with my kids. I've watched them tease each other, and they're getting ready to beat the high score or something, and they're really into it, and then it's payback time. My son Caleb would come in there and he would go, "Oh yeah, you're real high in the game, watch this," and boom, off the system, unplugs it or hits the button, and then chaos ensues. Okay, that's what manual intervention is like in the marketplace. Otherwise, it's going to do what it's designed to do, and it does not matter what you're doing with your controller at home, with your mouse and your buttons on your keyboard. All that moving around the mouse and all these buttons and trying to get in and buying and selling is having no effect on what these markets are going to do by the end of the day, because it's already predetermined, it's scripted, you have no say-so in the matter. You either get in sync with what it's going to do or you get ran over. Period. If you don't do it right, well, hopefully you have another player to use. If you can't respawn, you're out. You got to get another account refunded or determine whether or not this is for you. So you want to be able to look at these charts, not apply religion to it. Okay, no Wyckoff, no supply demand, no Elliott wave, no Darvas boxes, none of this mumbo jumbo harmonic crap. All those things, again, are just moments where it just fools them with randomness. That's all it is. When you apply time and price, that's the basis of what these algorithms are operating on. Then everything becomes clear. It tells you when not to do something, and it tells you when to do something. The missing piece is the money management. That's the part that you have to absolutely be impeccable with. If you're not, even knowing these things, when you start using them and you're doing very well with them, it'll make you feel invincible, that you can do nothing wrong. And as soon as you start feeling like you are a trading God, man, hello, reality check. You get smashed. And that's a real hard thing to come from. When you think you can't do anything wrong, and all of a sudden your world's collapsing because you can't control yourself, and you overtrade and you overtrade and you overtrade, and you don't want to go home with a loss. You don't want to close your week out with a loss, and you keep pushing and pushing and pushing, and then all of a sudden you can't meet the initial margin anymore because your account is gone. And you funded it with a Nations Bank credit card. Yeah, that's what I did. So in 1990s, that's what happened to me. And it's not fun. And you want to avoid all that. Just treat this like a business, obviously not like a video game. If anybody tells you, treat it like a video game, man, look, livelihoods are being maintained and held together with this industry. And it destroys them too. I don't look at any of this as a game. I don't. Now, learning in a demo, treat it like a game, yeah, because that way when you don't do well, okay, it's no problem. I can respawn. I can retry because it's not taking anything from me. But at some point you have to transition from, okay, I'm having fun and it can't hurt me, but now if I'm in live funds, this is business now. And I have to conduct myself with a business mindset and not take unnecessary risks. And maybe this style of trading doesn't feel like business to you. It feels like overkill. Okay, that's fine. But I'm only including this in the mentorship because I promised I would. For those individuals that want to do competition level trading, that want to literally beat the brakes off of everybody out there that thinks they're good. Listen, money management applied to this. Kelly, Optimal F. Forget about it. Like, you're talking hyperspace. Like, it is equity increases like you've never seen before. But you have to be dialed in and know exactly what you're looking for and pick your shots. Not every day is an opportunity like this. But when it's making itself available, man, it's like raining money. Just stick your pail out there and catch it. Other days, you have to work for it and be content with a little bit, a couple sprinkles. But when it's pouring like this one today, it's fun, real fun. And I wish I was home to get it all. But I have an anniversary and a wife to take care of on Monday, so that's what I was doing today. But I was still sneaking it in with my demo account, so keep that between us. All right, so until I talk to you, I guess on Monday. No, I won't be talking to you on Monday. Monday's my anniversary, so I won't be talking to you on Monday. So there you go. I'll talk to you on Tuesday through YouTube, and then we'll be back in sync on Wednesday with a midweek review. So I appreciate your patience in allowing me to make do on the promises I've kept for my wife for our anniversary. And with that, I will wish you a very pleasant weekend and be safe.